Welcome to episode 2 of our educational series on Real Estate Taxation Basics. Be sure to watch our series on 1031 exchanges and passive real estate investing basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
Jason, as we both know, depreciation can be, a very taxing topic. However, most of the complexity isn't in the concept, but in the numerous tax tables and regulations. Once you get the basic idea, you can let your CPA worry about the finer details.
When you invest in machinery or equipment, over time it will wear down, require increased maintenance, become obsolete, and finally need to be replaced. The IRS recognizes this and assigns a useful life to different categories of equipment.
You're allowed to write off the annual drop in value of these objects every year until their useful life is over. This process is called depreciation. The official IRS depreciation schedule for a machine or fixture can be anywhere between 5, 7, or 10 years.
Under the typical straight-line method of depreciation, each year you divide the original value of the asset by the number of years in its useful life. And under certain tax rules, you may be allowed to write off the value of an investment in a shorter amount of time. This is known as accelerated depreciation.
As it turns out, the IRS applies this same logic to the improvements that are constructed above and sometimes below the surface of your land.
Most types of properties fall into two depreciation schedules, a useful life of 27.5 years for residential rentals and 39 years for most everything else. Some entities like REITs are required to use a 30-year or a 40-year schedule.
Of course, the crazy thing about depreciation is that most buildings are not actually declining in value. Much of the time, you're claiming a depreciation deduction for a property that is actually appreciating. So why do we claim depreciation deductions for appreciating real estate?
Well, the answer is that you get to defer a tax today for a tax in the future, and at a rate that will likely be lower than your current income tax rate. For example, suppose you buy a $1 million triplex in California. The structure has a value of $275,000, and the land it sits on is worth $725,000. Each year, you would divide the value of the structure, known as the improvements, by 27.5 and deduct that amount, $10,000, against the income you earn from the property. You thereby lower your taxable income by $10,000 per year. If you're in the 30% tax bracket, you save $3,000 a year in taxes.
As we saw in the last episode, however, that deduction also lowers the cost basis of your property. If you decide to make any major improvements to the triplex, your accountant would track that additional value on a separate depreciation schedule. When you sell the property at a later time, the lower cost basis increases your capital gains at the time of sale. A special tax rate known as Depreciation Recapture is applied to the total amount of your capital gains that came from depreciation deductions.
For most taxpayers, the income tax they would have paid along the way is more than the depreciation recapture at the end. So not only do you get to kick the can down the road, the can's a little smaller when you get to the end. Unfortunately, many of our clients either forget or weren't aware that they have to effectively repay the deductions they've been claiming every year as landlords. For some people, this results in a capital gains tax that's 2 or 3 times what they expected. Please don't let this happen to you.
Thanks for watching. Please be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.